joined here today by Matt Strong, President of Post Brothers, Joshua Grossman, Vice President of LEM Capital, and Jeff Adler, Vice President of Yardi Matrix. Gentlemen, thank you so much for joining me here today.
Our pleasure.
When we look at the US multifamily sector, it's undoubted to say that the pace of transactions has certainly been growing at a very strong level for the past few years. It's led many industry professionals to really say that this is one of the best environments for multifamily investing in a generation, but it also means it's exceptionally competitive. And today we're here to look at the reality of what's going on for multifamily, what's really happening in terms of fundamentals, and how that's impacting strategies across the board. Now, when we do look at fundamentals, we obviously look to the demographics. And Jeff, let me open this up to you. Is this round of demographics much more different than what we've seen before? And is it really kind of extending that multifamily cycle that we're perhaps seeing?
I think it's very much the case. I mean, the demographics, and not only the demographics and market conditions, this is probably the perfect storm we've seen in multifamily for the last 30 or 40 years. So you have two very large cohorts. The millennials are about 78 million. They are now hitting their prime kind of rental ages, as well as the boomers who are sort of now entering their 60, 65, another 78 million cohort. So in addition to just pure size and the age, you also have, I'll call it demographic preferences, which is this group is delaying marriage and delaying child rearing longer. They have a preference for urban type living, though not necessarily central city living. And they're much more associated with a live, work, play kind of experience. So all of these things, in addition to, quite frankly, the financial environment where you've got student debt, you have a blowout from the last cycle on the housing side, so they're not necessarily think of housing as a great investment anyway. All are driving this towards just an amazing multifamily kind of cycle. So most people, when you think about, they always ask me, what inning are we in? What inning are we in? I would say that we're kind of in the sixth inning of a game that's going into extra innings.
Is this going to be an extra innings in terms of the multifamily real estate cycle?
We see continued absolutely excellent fundamentals underlying the dynamics of the markets in which we own. That being said, I can't speak to any markets besides really Washington to New York, that corridor. But I think that certainly a dose of conservatism is called for when looking at new investments in terms of the underlying fundamentals of rent growth, because at some point, not every property can be Class A, and rents can't be pushed forever, because rents in a lot of places are pushing up on the sort of affordability ratios you look for when you're underwriting, residents to live in the apartments.
And Josh, is this going to be an extended real estate cycle, do you think?
We think the fundamentals are very, very strong. I mean, the pool of potential renters is just enormous. I think we'd be, as a firm, we're very much focused on kind of the fat segment of the bell curve, that Class B product. If the new product's being delivered at $225, $250 a square foot rent, we're really focused on that $125 to $150 square foot. And those are, certain markets, especially on the West Coast, vacancies are very, very low. Wages have not been increasing as fast as rents have, and single family home prices are going up and people need places to live. So we think there's a huge amount of demand, but you just have to just where you focus on the bell curve.
Yeah. I mean, one of the things that we've begun taking a kind of a deep look at is a lot of investors have come to us and said, well, we want to leave the top six markets, right? Our primary markets. We want to search for yield, and so where should we go, and why should we go there? And so we began kind of thinking about, well, what makes a primary market, and are there a set of secondary markets, but really quite large American cities or metropolitan areas that actually have the attributes of a primary market,
they
or
call
almost
18-hour cities.
They're 18, not 24. They're 18 exactly. And so we went through this notion of saying, well, there really was kind of three main drivers. It was, is there an intellectual capital set of nodes? So it's not just that there's employment, but what's the nature of the employment, and is it such in the creative industries where wealth is getting created? And then is the business climate one that's conducive to creation of new jobs? And then it kind of passes through a screen of civic leadership, which is if you look at income growth and income distribution, for the last 30 years, it's been highly concentrated toward the upper end, where education exists.
I think it's important when looking at markets. I think it's important to take a nuanced perspective, because if you're trying to have a project that's calibrated to a kind of a low, like a middle market tenant base, it's okay if that job base is nurses, it's teachers, it's administrative assistants, it's office workers. If you have a property that's much more focused on a higher end demographic, then you need some of these research techs, docs, software programmers.
Right.
People like that.
And how exactly are you kind of executing on those strategies? How does that impact in terms of, what you're delivering?
We really see an opportunity to focus on, within our markets, what I would call the white-collar college graduate segment. If we're focused on buying something that is suburban, it's got to be in a real infill location. Inner ring suburbs that have walkable kind of downtowns and trains. We love those markets, and we think they're underserved.
And I think that is what is defining kind of this cycle compared to past cycles.
Yeah.
It is this notion of either access to transit or access to walkability is where value is getting created and where value will continue to be created. And the data is pretty clear that in 10 years, the millennials will move out to the suburbs, but the suburbs will either be your infill type suburbs with transportation, or the suburbs will look like that. They'll have retail nodes and office nodes and walkability or transit nodes, so it looks like it.
The suburbs are cheap right now, but they're cheap for things that are obsolete, generally, across not just apartments, across office buildings. Suburban office is cheap, but suburban office needs to change.
Where's economic growth occurring? Where's valuation going to occur? Okay, for places that don't normally aren't blessed with intellectual historic capital, like Boston, like New York, or to a certain extent like Philly or DC, they are creating places that will attract capital and where rents will grow over an extended period of time because they're making these infrastructure changes.
We work with local guys in every market who understand, know every block, the history of every trade, and they're willing to, and you look at the major 6 markets, you're focused on buying, I think, more focused on buying the MSA. When you get down to these kind of secondary and tertiary markets, you're more focused on buying, a zip code. Or you're buying like a property that's relevant to a specific 2 or 3 sets of employers, or a specific school district.
Are you getting much more into specific sub-markets then when you're actually looking at the secondary and perhaps even the tertiary markets?
What's interesting, I'll take an example of Houston, which you think is all energy related. It's actually not one city, it's actually 10 cities. There are 10 nodes, okay, of where there's a combination of the kind of people who have intellectual capital, the retail and the office. So you are buying, and if you're going to be successful, you have to go beyond the metro area into where those particular nodes placed.
We spend a lot of time also focusing on retail development. We think, people like Walmart, Costco, Whole Foods, they do great demographic research, and it just portend positive demographic trends in an area that's, transforming.
What are you seeing in terms of capital flows into these secondary markets then? Because people seem to be wanting to take on more risk.
We invest in basically anywhere that's 2 hours from downtown Philadelphia, so north and south really, and I would say the entire state of New Jersey is kind of a primary market in terms of multifamily. So generally what we're doing is buying something that's potentially an area that looks bad because of the asset we're buying and changing it. So sometimes people are afraid of that, but if you can find that today and you believe in the other things about the cycle holding up, there's an incredible opportunity to be made there.
What's interesting about real estate, and I'm talking at the moment about multifamily, but you could say this to other asset classes, is there really is a tremendous number of value creation strategies. For a long time, people kind of shied away from it because they said, oh my gosh, it's development risk. You're going to basically gonna basically almost tear the thing down because you got to put new building systems in.
Everything.
You got to put in everything. Now, the difference is if a replacement cost is $200,000 a unit and you can get the thing for 40 or 50, and so even if you put 50,000 into it, you just created a tremendous amount of value. It's just that you got to be very careful about how you find them.
Josh, are you finding that the secondary markets are becoming even more liquid, that capital is really kind of flowing in? It presents a great exit strategy, but it's also competition as well.
I think 12 months ago, even 18 months ago, you definitely saw cap rate spreads. I think recently they've compressed. So, maybe you still get a little bit more yield. You get 25 basis points, maybe 50 basis points of cap rate in somewhere like a Birmingham, Alabama versus in Atlanta. I think that's going to decrease further. And I think those markets, they're just harder to understand. And you have to be with, the right local guy who knows it, block by block like you guys do, Philadelphia and Jersey.
I think going into a market without an operating partner, which you guys don't do. I mean, I think that going in and saying, everyone in Birmingham's an idiot and I'm going to make a 30 IRR on this deal is a surefire way to not make a 30 IRR. I don't, we get lots of deals sent to us all the time. I don't really see, any type of premium discount rather in these secondary markets, in these secondary markets relative to even the major secondary markets. And I would say the secondary markets are just priced like the suburbs of the absolute first-tier cities, period.
Are any of you getting concerned that there is too much excess development kind of happening, or is it really in very select pockets?
The city of Philadelphia and the state of New Jersey have a lot of development going on right now. Historically, more than ever has happened at once. We developed a building and then we consciously chose not to develop anything else downtown because there were a dozen other projects in various stages of planning, and that doesn't sound like a lot, but it's maybe 70,000 people in the greater downtown, and the real Class A plus renter demographic's not enormous. So we stopped developing there once we started developing this building because we thought that there was a potential of the symptoms of oversupply coming on. In fact, the opposite happened. And there are some projects I wish we would have done in those intervening years because we would have had done really well. So I can tell you that simply the 80 million millennials, if you're a place where they want to be, I honestly don't think developers can permanently overbuild any markets. Maybe a few.
That's quite a broad, quite a contrarian
well, I'd say
view.
we've taken a look at job growth and graphed it against apartment completions as a percent of the stock, which I always think that's the relevant measure, right? And there's only really 3 markets right now that are, I would say, oversupplied or about to be oversupplied, which is really, Charlotte, Austin, and to a certain extent Nashville. And I think all those, they're also high job creation.
Yeah.
So I think it's a question of, it's a timing. Now, if you look at the other markets, there are sub-markets, at the high end, because all the stuff is coming at the high end in the central business district, they are going to be oversupplied for 18 months. So rents won't go up quite as fast. They'll go up 4 versus 8. Still, you'd take that to the bank all day long.
That's a developer's problem. It's not the common equities problem. Right?
Yeah, and so if you think about it, that's still really good. Now, I would say the one thing that really talks to Josh's strategy, and to a certain extent yours, Matt, is the gap between the higher end and the mid-range is very, very wide. It's at least $500, $600, $700 a month. And if you think about that, you're really talking about entirely different renters.
So the value add strategy that Jeff mentioned about pushing Class B rents, I think you have to be very careful about estimating inelastic demand vis-a-vis the income of people in the middle. So Josh, what type of business plans do you see being successful in terms of going from kind of a C to a B? Like, what works?
A lot of what we're focused on is that kind of fat segment of the bell curve, right? And what you're doing is you're buying a late 80s, early 90s vintage deal. It's generally been undermanaged. The guy's in out of town. He may be using a third party, but he's not really paying attention. The deal's capital starved, and you can come in and you can spend your dollars. You can create almost like new amenities, heavily focused on the leasing tour, and interior finishes that are very well calibrated to the tenant base. And we're very, very focused on incremental return or return on incremental dollars spent. So if we're going to do granite counters versus, without being too esoteric, if you're going to do granite counters versus laminate counters, you have to make sure you're getting paid extra rent dollars for the extra, $1,000 you're spending. So I think what we end up with is a product that's well calibrated to a tenant, where they can come in and they're making that 40 to 50 grand a year. I would just also say there's also different components of a value add, right? Because you have some dollars that you think you can charge to just bring your product to where it should be within its rightful place in the competitive set. You have dollars that you can generate by executing a value add program and improving finishes, giving tenants better amenities, et cetera. And then you have whatever you get from the market. So we're very, very focused on manufacturing yield, and we're not buying these deals and just riding the market. These truly are value add opportunities.